Hello and welcome to Money Tree. Thanks for tuning in again. Today we continue in the video series, Principles of Value Investing. But now let's start. Our entire life is determined by emotions and we react emotionally to events in life, be it in everyday life, at work, etc., and usually act without thinking much, purely instinctively. This instinctive action is one reason why we often make wrong decisions, not only in everyday life, but also on the stock exchange, and there especially often. Because when it comes to stock market transactions, instinctive action tempts us to do exactly the wrong thing and to do it over and over again, letting ourselves be driven by greed or quickly falling into panic. Let's take an example that everyone will know. Although the company you invested in is doing well and there was no bad news either, the price starts to fall. The price falls bit by bit and you start to wonder why. And after a short while you start to think about selling the shares. And just when you've given in to that impulse, that survival instinct, the price turns around and the stock goes up again. And that is exactly what is annoying and avoidable, because the processes, whether on the stock market or emotionally, are almost always the same. In this example and also in the real stock market business, one does not sell the company but the market. They are sitting on high price gains and are afraid of a crash if the price falls. For this reason they sell their shares. At the same time, most investors have no idea what the company is doing, how it is doing. They just know the price and bought the shares only because of hot news, because someone else bought them and made profits. Now the price is falling and they start thinking that someone must know more than they do, and they don't want to be the stupid ones to be the last to get out and take losses. But it is exactly this behavior that makes them the stupid ones, the losers, because the price will rise again when the emotional selling pressure subsides and they are no longer in the game. They will not get in again either because they do not trust the price rise. And that's the way the stock market is and always has been and always will be. Fear and greed drive the prices, but in the long run the price gains are only driven by patience, analysis, and stock picking. The majority of us tend to perceive and remember negative experiences more intensely than positive ones, and we pass on our negative experiences more often than our positive ones. For this reason, our emotions are stronger when we experience losses than when we experience gains. The loss aversion that results from this behavior leads investors to avoid divesting from stocks even when they are far in the red, and to do so out of fear. Fear of the losses resulting from the sale and only fear of the losses. They are not held because the company offers outstanding prospects. For this reason, if you can't sell, you should definitely cheapen, i.e. repurchase, in order to improve the cost price. It is precisely this fear that tempts investors not to let profits run, but to realize them prematurely. The really big price gains are simply left behind, because the probability that a stock will generate another all-time high after one is much higher than that it will fall again. If you look at the Dow Jones over the last 100 years, you will see that despite periods of losses, there have been far more all-time highs, and again and again. Stock market legends like Warren Buffett owe their lasting success not only to luck, but primarily to their ability to see the stock market in a purely rational way. Many people are happy when the prices of their shares rise and frustrated when prices fall. Warren Buffett and other stock market giants do not think about the market value of the shares. This is secondary for them, because they do not buy shares but shares in a company. Warren Buffett would also buy the companies if they had not issued shares on the stock exchange, but buying on the stock exchange by means of shares makes it immensely easier for him to buy the company. Warren Buffett looks at a company according to its value and not according to its current market value, and so he does not regard falling prices as a loss or a reduction in assets, but rather as an entry opportunity. For his purchases, Buffett determines the intrinsic, fair value of a company and then subtracts a safety margin from it. This result is his maximum entry price. He consistently adheres to this method, thereby increasing his chances of making money on his investment. But until this price is reached, several years may pass and he has the necessary patience to wait until his chance has come and then he acts. I don't think about if the market is going up or down. I only care about buying a company at an acceptable price. I don't see myself as part of a bull market, but as a partner in wonderful companies. I need to buy at a price that makes me happy. Warren Buffett. As an investor, you can learn here that you should not consider your investments in relation to the entry price, but rather you should pay attention to whether the investments are attractively valued and have a positive outlook for the future. If they meet this criterion, you should hold them or even increase them, but if you come to the conclusion that they do not meet the criteria, you should not invest in these stocks or even sell them, regardless of the price at which you entered. We close today's video with a quote from Seth Klarman. Investors often make the mistake of taking market fluctuations as fact rather than opinion. I hope you enjoyed the video. About a like and subscription I would be happy. Until the next time.